Hi there, welcome to Kneppy Invest. Let's talk about Perenti, a company that used to be called Ausdrill, and then they changed the name about 3 or 5 years ago because of a few acquisitions the company did make. A company I have owned in the past, but I would never, ever own this company for the long term because they are or can be quite cyclical. And you'll see that cyclicality, whatever you want to call it, when we look at the chart, even at their financial performance. Now, I probably describe Perenti as a mining services company, and I'm not sure that's 100% accurate, but for the purposes of this video, we'll describe Perenti as a mining services company. So before we have a look at what this company does, look at their financials, the company actually did release a business update on June the 6th. So let's have a look at that business update right now. Not only was this a business update, it was a strategy briefing. And to be fair with you, I haven't gone through the whole announcement. I just wanted to look at this business update. And it was positive. It wasn't sort of hit the ball out of the park positive, but it definitely wasn't negative. Now, because this company is a mining services company, they have a lot of revenue, but because of very low margins in that sector, not a lot of that revenue falls to the bottom line. So they are expecting revenue in financial year 23 to be 2.9 billion, which is at top end of their previous range. So the previous range was for revenue to be between 2.8 and 2.9 billion. So they have hit their targets. They also expect EBITA, so not including depreciation, of between 260 and 265 million, and capital expenditure of 290 million, which is a little bit down from the original guidance of 330 million. And that's very important because this company is capital intensive. You'll be able to see that when we look at some of their financials later in the video. In fact, one of the biggest red flags I have about this company is the big difference between operating cash flow and free cash flow. If you just look at the operating cash flow, this company is impressive and you could say undervalued. But when you look at the free cash flow, it is quite mediocre because of the capital expenditure. The other thing this company did is they gave out some financial year 24 guidance and financial year 25 guidance. For instance, their financial year 25 revenue target is between 2.5 and $3 billion. So that means they're expecting revenue to go from $2.9 billion in 2023 to $2.5 to $3 billion in 2 years' time. So there is a good possibility revenue for this company will drop over the next 2 years. And that is not the sort of thing I want to see for a company I have in my portfolio for the long term. I want to see revenue growing at a fairly consistent, persistent rate over time. And Perenti doesn't seem like they will have that based off their financial year 25 revenue target. For full disclosure purposes, I am not a shareholder of Perenti. I have been a shareholder of this company in the past, and typically I will be a shareholder of this company for about 3 to 6 months. Recently, I was a shareholder of this company because it did look like things were moving in the right direction for the company. But however, over the last 3 to 4 months, share price has really done nothing. And even though the market did have a nice reaction, when I say nice, it was up a little bit after their business update on June the 6th. The share price of Perenti has really done nothing since then. So let's get into what this company does. And I've already said this is a mining services company. If I had to accurately describe what Perenti does, I would call this company as a contract mining company. And you'll be able to understand why I call or would call this company contract mining company when we look at how they get their revenue. So they have different businesses within their contract mining sector. So this is just not one business. Now, they used to be called Ausdrill, which is one part of their contract mining business, but they also have Barminco, AMS, which is African Mining Services, and they also have African Underground Mining Services as well. But Perenti also has some mining services company as well, Supply Direct, Logistics Direct, and BTP. And Perenti also has another division called Idoba with Orology company within that. I didn't really explore what Idoba actually is. And there's a main reason behind that. And it comes back to revenue and margins of this particular division. Potentially, it is a significant growth division for the company in the future, but right now, it's a very small part of what Perenti is doing. And because it's a very small part of what the company is doing, I decided not to have a close look at what exactly Idoba is. So let's have a look at the breakdown of revenue. And this is why I probably would call Perenti as a contract mining company instead of a mining services. So they've broken down their revenue into two distinct divisions. Contract mining, and they've broken that down even further into surface and underground. And they've lobbed together mining services and Idoba into the same division. So this company in the half year, and this is half year numbers. So in the half year, this company produced $1 billion in underground contract mining, $340 million in contract mining surface, and only $107 million in mining services and Idoba. And then if you also have a look at the reported segment EBIT, the majority of this company's EBIT is in contract mining. In fact, only $4.4 million of EBIT in mining services and Idoba. So again, I probably would classify Perenti as a contract mining company, not necessarily mining services, although you could argue that contract mining is mining services. The current CEO and managing director of Perenti is Mark Nowell. He's been in this role for almost 5 years, September 2018, and he has extensive experience in mining through different roles throughout the world and also throughout numerous countries. He has expertise in underground, open cut, and process engineering operations across a variety of commodities, including iron ore, gold, copper, diamonds, nickel, and oil sands. So he seems to be the right person for the job. And the very fact that he's been in this role for almost 5 years seems to suggest that he's doing, or so far, doing a fairly good job at Perenti. Now onto the quality, and it should not be a surprise when you hear that I would classify Perenti as a low quality company. So with low quality companies, I'm typically looking for short-term trades, maybe even medium-term trades, when times are good, when the chart looks favorable, when sentiment is positive in regards to the company. So why would I classify Perenti as low quality? So just look at some of these numbers. So I always look at revenue growth over certain periods of time, 10 years, 5 years, 3 years. Also look at trailing 12 months. Also look at return on invested capital, return on equity, valuation numbers, which isn't necessarily indication of whether a company is high or low quality, just if it's expensive or cheap. Also total returns over a 10-year period. So revenue growth over the past, and revenue growth is per share, by the way. So revenue growth over the past 10 years is 0.4%. So that's not necessarily the sort of revenue growth per share I want to see. But it's very important to note that this company went through some bad times in 2015 and 16 because Perenti is cyclical, and that was sort of the downturn in the mining sector. You'll be able to see that on the chart for any mining companies on the ASX. In fact, BHP went below $15, if I remember correctly, in 2015 or 16. That was a perfect time to buy some of these companies. So if you look at the last 5 years, after that downturn, revenue growth for Perenti has been 8.2% per year. Over the last 3 years, 8.3%. Now, return on invested capital is quite low. Return on equity is quite low as well at 3.8. So typically, I like to see return on invested capital a little bit higher than that. Even EBIT at 8.2, suggesting there might be some value. But typically for these type of companies, I'm not looking at value plays. I'm looking at really good sentiment. And if I am looking at value plays, typically in the downturns, when the company's share price has collapsed, it actually looks expensive. That's very true for mining services company. So don't necessarily look at the valuation metrics and think this company is cheap or expensive and then make a decision on whether to buy a company based off that. Total return over the past 10 years is negative, which is not a good thing to see. So if you've been holding this company for the last 10 years, you have seen negative 4.9% returns year on year. So again, I classify this company as low and only a trading stock. And my notes on Perenti, low return on equity and return on invested capital, though accelerating revenue growth. Now, some of that revenue growth might be because of some acquisitions, but again, this is revenue per share. So I don't mind to see revenue per share growth if a company has made some acquisitions. And then I've also mentioned here minuscule growth over the last 10 years. Now, a few facts in regards to Perenti. Company listed on the ASX in December 2006, just before the GFC, or maybe 1 or 2 years before the GFC. Share price at the end of trading on June the 9th, not May 26th, is $1.20. Now, the company has 683 million shares on issue. Another thing I like to look at is how the shares have increased or decreased over the past 10 years or since the company listed on the ASX. And for Perenti, that is over the last 10 years. And shares on issue have more than doubled. And one of the reasons behind that is because of some acquisitions. So that's not necessarily a negative thing, but keep that in mind. Shares have doubled for Perenti. Now, at a share price of $1.20, with 683 million shares on issue, this company has a market cap of $815 million. Now, let's have a look at some of the financials trailing 12 months. If you don't know what trailing 12 months is, it's just looking at the last 12 months. So the first half of financial year 23 and the second half of financial year 22. So revenue 2.68 billion. Remember, they're expecting revenue to be 2.9 billion in financial year 23. So revenue has increased a little bit over the past year. Profit 56 million. So again, this company has really low, tight margins. And if something bad happens in one of their operations or something, that could have a significant effect on their profit. So keep that in the back of your mind. I've seen this play over time and time again over the past 10 years with these low margin business. One bad thing happens and the company can implode. Operating cash flow, way more impressive than profit, 369 million. And you might see that the free cash flow is actually negative. The reason the free cash flow is negative is because of the amount of capital expenditure this company needs to do every single year. So remember, they're expecting capital expenditure to be about $290 million in financial year 23. And return on equity, return on invested capital, quite low, which is a sign of a low quality business in on itself. To get a better understanding of a company, I do like to have a look at the cash flow statement, the balance sheet, and the P&L statement. So let's have a look at the cash flow statement, because I've already mentioned this company is capital intensive. They spend a lot of money on capital expenditure, and in the cash flow statement, you'll see property, plant, and equipment, and that is capital expenditure. So if you start at the top of the cash flow statement, you've got receipts. So it's a roundabout way of saying revenue, but they're not exactly the same. And sometimes there can be a big difference between revenue and cash receipts. So this is just cash receipts coming in the door. So $1.5 billion of cash receipts. But remember, this company has very low margins. So the operating cash flow was quite good at 158 million. And if you just stop there, you'd think, well, this company has a market cap of $800 million. Operating cash flow is 158, so they're looking fairly cheap. But again, they are capital intensive. In fact, in this half year, they spent $165 million on the purchase of property, plant, and equipment. Again, that's capital expenditure. But they also received from the sale of capital of $13 million, and they also received from the sale of assets held for sale of $10 million. They also borrowed some money to pay for the capital expenditure, and they also paid about $15.8 million on lease liabilities, which is an ongoing cost. So even though this company was operating cash flow positive by 158 million, if you take into account capital expenditure and lease liabilities, this company was free cash flow negative. And not only that, the company is paying for share buybacks. Almost $38 million in share buybacks, looks like. So overall, the net decrease in cash and cash equivalents was $23.2 million in this particular half year. But the good thing, the positive, is they have a lot of cash on hand. And at the end of this particular half year, the company had $322 million of cash. But on the flip side of that, the company also has a lot of debt. So this is the balance sheet. So I always like to look at the cash flow statement and the balance sheet. I want a fairly healthy balance sheet. And some things I'm looking for here are inventory, receivables, payables, borrowings, and I don't want to see borrowings way higher than total equity. So you might hear some experts talk about debt to equity. So you find that you can calculate that just by looking at the balance sheet. So cash and cash equivalents, we've already seen that from the cash flow statement. It is quite good. Trade and other receivables, 390 million. Inventories, 228 million. Trade and other payables, about 327.7 million. Also like to look at changes in working capital, which is trade payables, receivables, and inventories from last year to this year. I'm also looking at debt, which is borrowings. So borrowings in the non-current liabilities is 844 million. So even though they have a lot of cash, this company is net debt by about $520 million, and total equity is 1.4 billion. So market cap is actually significantly lower than the total equity. So the price to book of Perenti is almost 0.5. With a price to book of just above 0.5, you might think that Perenti is quite cheap. So this is the price to book history of the company since 2013. And typically the price to book of Perenti is well below 1. Only for brief periods of time in 2017 and 2019 was a price to book of this company just above 1. In fact, back in 2014 through to 2016, the price to book of this company got as low as 0.1. So even a 0.58 price to book is not necessarily a sign that this company is good value. Now let's have a look at the 10-year revenue and operating margin history for Perenti. And I've already mentioned that the bottom of the cycle in the mining sector was around about 2015 and 16, and that was the bottom of the revenue cycle for Perenti as well. The revenue got down as low as $720 million in 2015 with very minuscule operating margins of 3.9%. But revenue have recovered. And one of the reasons revenue has recovered for this company is because of acquisitions. So revenue has increased from 720 million to 2.5 billion, and they're expecting that to grow to as high as $3 billion by financial year 25. The other thing you'll notice here is operating margins have fallen over the past 10 years. In fact, in 2013, operating margins were 11.4%, and recently they've been as low as 3% in 2019, 3.8% in 2021, in the last financial year at 5%. So I would like to see operating margins increase from here. So even though revenue is increasing, operating margins are on the low side. One easy way to see or figure out if a company is high or low quality is just have a look at the dividend history. And you want to see dividends growing through time. That's actually a fairly good sign. For Perenti, you don't see that. In fact, their highest dividends were way back in 2013, and the company didn't have any or give their shareholders any dividends in 2016, the bottom of the cycle. And over the last 4 years, dividends have been relatively flat. So this is fairly common when you look at low quality companies. Not much growth in dividends. In fact, sometimes you'll see dividends dropping for low quality companies. Now onto some valuation metrics. And to be honest with you, I don't spend a lot of time looking at these metrics or, just paying any particular attention to what these numbers represent in terms of whether a company is good value or expensive. Now, P ratio 13.9 wouldn't necessarily say is high or low for this company, but when you look at the price to book ratio, 0.57, on first glance, you might think that is low, which could be suggesting there is some good value, but I think that could be deceiving because we have seen the history, price book history of this company, and 0.6 is about right. For Perenti, doesn't suggest it's overvalued, doesn't suggest it's undervalued. Now, the price operating cash flow could be deceiving. So if you only looked at the price operating cash flow for all companies and you saw 2.1, you might think this company is a screaming bargain. But I think that is deceiving, which I've already discussed about. I would prefer to look at price to free cash flow, but that would be negative for Perenti because they have negative free cash flow. Now, I did do a reverse DCF based off the earnings per share. I couldn't use free cash flow, and I didn't want to use operating cash flow, so earnings per share it is. And to justify the current valuation, Perenti would have to increase the earnings per share at 7.3% per year over the next decade to justify the current valuation. They could achieve that, but I definitely can also see a scenario when they don't see 7.3% increase in earnings per share, particularly if there's another significant down cycle in the mining sector. Now let's have a look at some charts. And this is the weekly chart for the company going all the way back to 2011. So we're looking at a 12-year history. And the reason I want to go that far back is because this company went through some good times back in 2011. So 12 years ago. In fact, the share price went to a high of $4.40 in 2012. So the first few months of that year. And then you see the share price drop from $4.40 all the way down to 25 cents. So remember, the bottom of the mining cycle was back in 2015 and 16 when the share price of this company got down to 25 cents. That's the time to be thinking about buying these companies. And if you had a look at the valuation metrics, you would have seen a P ratio sky high or maybe even negative because the company wasn't profitable. And there would have been possibly some concerns about the ongoing nature of this company. I wasn't following Ausdrill at that point in time, but the very fact the share price dropped all the way down to 25 cents. But then they made it through those bad times, and the share price recovered quite well from 2016 all the way through to 2018. In fact, the share price went from 25 cents to about $3. So we're talking about a 10-bagger over a short period of time. So just by looking at this weekly chart over the past 12 years, you should be able to understand why I'm only willing to hold these type of companies for the short to medium term. Maybe as long as 1 or 2 years, but definitely not for the long term. Because since those highs back in 2018, when the share price got to about $3, the share price has been dropping. And only recently, just by looking at the weekly chart, has the share price moved into a short to medium term uptrend. Now let's zoom in on the last 12 months, looking at the daily chart here. And you can see, just by looking at this particular daily chart, the share price of Perenti has moved into an uptrend. You probably couldn't say that in the very short term because share price is going sideways ever since the highs back in December. But for the long term, the share price is still in an uptrend. In fact, the share price has been in an uptrend since late last year when the share price fell to a low of about 58 cents. So the share price has more than doubled since those lows. But in saying that, the share price has been going sideways over the past 5 to 6 months. That's one of the reasons I did take profits, set out of my position, just because the short term is more volatile and really going sideways. But if you're looking at the long term, there is still suggestions that Perenti's share price is in a long-term uptrend. How long that lasts, I have no idea. And simply because I don't think this is a long-term hold, I don't particularly look at the long-term trend. I'm more interested in the short to medium-term trend. And the short to medium-term trend suggests share price of this company is not going higher, not going lower. So that's why I took my profits and sold out of Perenti. The next 5 companies I'll be focusing on in Kneppy's analysis series include AGL, Mass Group, and I believe Mass Group will be the next company I'll be looking at, then Lycopodium, and Technology One and Universal Stores. If you do have a suggestion of a company you'd like me to feature in Kneppy's analysis, just leave your suggestion in the comment section of this video, and there is a chance I'll take your suggestion on board and look at and feature that company in the Kneppy's analysis series. That's all I have for this video looking at Perenti. If you have any more questions about this company or some comments you'd like to give us in regards to Perenti, maybe you're a long-term shareholder of this company, I'd love to hear your thoughts. So leave your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day.